You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of timely topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this series. And in today's conversation, we're going to discuss the state of the U.S. economy. First of all, the U.S. Consumer Confidence Index, and then the forecasts for the U.S. GDP. Joining me today are Lynn Franco, our Director of Economic Indicators and Surveys, and Erik Lundh, our Senior Economist for the U.S. Erik and Lynn, thanks for joining me. So Lynn, we're going to start with you and the U.S. Consumer Confidence Index. The November index fell again. Lynn, what's going on?
Yes, Steve, we actually fell to 100.2. It's the second monthly decline. And what we saw is sort of both components contributed to this decline. The present situation softened a bit more and consumers' expectations remained very weak.
Now, the present situation, so describe what the two of them mean.
So the present situation takes a look at how consumers assess current business conditions and current employment conditions. The expectations index takes a look at their expectations 6 months out regarding business conditions, employment, and income expectations. So that gives us sort of an insight as to what's happening at the moment, sort of a current view of the economy and the labor market and what consumers expect 6 months down the road.
And did they both fell, both these components fell and contributed to the decline, but did one fall more than the other?
I think, we've seen a little bit of a lesser decline, let's say in the expectations, but the level here is what's critical. It remains below 80, and that's sort of the line in the sand that tells us it's sort of flashing recession. And it's been below 80 for several months now. So we really do see sort of this risk of recession rising, and consumers continue to feel that there is a recession on the horizon.
Yeah, and so it seems to be that they're more, it's less about what's happening at the moment, but more about what they're worried about that's coming. Is that fair?
That's fair, but I think also we have to sort of take a look at how they're assessing current conditions, even though that remains relatively strong. We've seen now some, declines and some weakening. So what that's telling us is that the economy is losing momentum as we wind up 2022.
Okay, now we also talked to them about their intent to purchase items, and you ask about big ticket items like houses and cars and so forth. What'd they tell us this time?
Well, what we've seen is a little bit of cooling in purchasing intentions, whether it's homes, autos, or, big ticket appliances. And that's, a combination of a variety of different factors. We've got interest rate hikes and still more pending. We've got inflation, which, continues to sort of rear its head. And we've also got the shift from durables to services, right? So we're going sort of out of that pandemic mode when we were buying, washers and dryers and refrigerators, more outdoors, more sort of activities outside of the home. So it's the variety of these three that are sort of causing, what we're seeing in terms of these big ticket items.
Well, and clearly as the Fed raises the discount rate and therefore interest rates on all borrowing goes up, it becomes a lot more expensive to buy these big ticket items. So how much of it is due to that? The cost of making these purchases is not just the money out, but it's the interest rate.
Well, I think a lot, especially in terms of homes and autos, right?
Yeah,
Both require a loan. And if you're not purchasing a home, then you're not going to buy an appliance to put in the home. So I think we're going to continue to see a little volatility in these buying plans, which is normal. But I think sort of just an overall trend where we see a little bit more cooling in the coming months.
Now, there are also some differences in demographics. I think we saw that the 55 plus population lost confidence at a higher rate, and the lower income classes. What does that say?
Right. So yes, we're seeing, a bit of a divergence, let's say, within the age group, even within the income groups. But if you sort of take a look at sort of what's been happening on average, we're sort of ending the year on, much less solid footing than we started the year. Both, consumers, irrespective of age or income, were much more confident in the first few months of the year than they are at this current moment. Not as low, not as low as perhaps we saw in the summer months, but we don't see much upward momentum here. And I think also too at play is inflation, right? This is quite evident when you take a look at sort of the higher income versus lower income consumers, with the lower income consumers being much more impacted by rising prices, whether it's food or gas.
Yeah, this is a really good point. I think the people who are retired and therefore in the 55 plus group have a fixed income, right? And by definition, fixed means it's not inflating. And so, even all their expenses are inflating, and that really affects people who are trying to live on retirement. But this whole thing about gas and food have been the story here for months. We have double-digit inflation on both. And you talked last time about how the consumer confidence index, it has been tracking somewhat to gas prices.
Right. I mean, it's right, front and center. It's very obvious. You can't drive but a few blocks before you see what's happening at a particular gas station. I think some of the uptick that we saw is causing some of the downtick in consumer confidence. And so we'll probably continue to have a little bit of this volatility as, gas prices go up and then come down a little bit. But I think the key driver overall is going to be what happens in terms of the labor market in the coming months, because that is the key pillar behind, supporting consumer confidence.
So if you're putting your entire paycheck in the back end of the car, you don't have a lot of extra to spend on other stuff. This is the season to be jolly and also to spend like crazy, right? So what's happening with the holiday spending?
Well, interestingly enough, we got off to, it seems like, a very strong start over Black Friday and the weekend. And so we saw, consumers out shopping in full force, right? Taking advantage of a lot of the steep discounting and offers that retailers were giving. However, what's interesting there, and I think sort of gets to your point too, is that we also saw a bit of an uptick in sort of consumers who are willing to buy now, pay later. So, perhaps that's going to impact spending in a few quarters down the road as the bills become due. But it still remains to be seen if sort of this momentum that we started the season with continues in the coming weeks.
Well, I've seen numbers that suggest that the holiday season so far have sales up 2.5%, round numbers. But, if we're seeing 7 to 8% inflation, that means that's real volume declines, doesn't it? So, if inflation had come all the way through, you'd expect the sales to be up 7, 8%, but it's only up about 2.5%.
Right. And in fact, when we did our holiday survey back in October, we sort of saw this shift, right? So there was the intent to spend less on gifts because more was going to go for, the non-food items around the holidays. I mean, the non-gift items. So I think inflation is obviously having a big influence here, not only in what consumers are purchasing, but how they're choosing to pay for these purchases.
Yeah, so it could be that volume, real units are down, but also, if there's a ton of discounting, which you mentioned earlier, more so than in the past, that also could be accounting for the difference between the inflation rate and the 2.5%. But still, 2.5% is positive.
Yes, yes. So again, let's see what happens. We know the Saturday and the weekend before the holidays always another big purchasing event. So let's see if consumers continue to have as much cheer in the coming weeks.
Yeah, still a lot more of the season to go. Okay, so you mentioned jobs, and so much of consumer confidence overall is dependent on where you sit, right? So if you're confident, if you have a job, you feel good about it, your income is coming in, even if there's some inflation erosion, that's a lot better than not having a job. So this is a really different kind of a situation. We're projecting at the Conference Board that we're going into a recession. You hear that from CEOs that we talk to, and this consumer confidence survey suggests the same thing. And yet people are positive about jobs and the job market is held up.
Right. And I think what we've seen, and we may continue to see, especially from our CEO confidence survey, is that, as opposed to layoffs, maybe the positions that are open now just go unfilled, right? So that we have sort of this job full recovery, which is quite different from what we've seen in past recessions.
Yeah, well, no two recessions are the same, but this one is definitely very different. Anything else from the consumer confidence results that you'd like to share?
I just think that, inflation, interest rate hikes are going to sort of continue to be headwinds. And if we see any sort of substantial softening in the labor market, that could have a detrimental effect on consumer confidence.
Yeah, and of course, if jobs are lost, then incomes are lost, and then there can be a downward spiral. So it'll be very interesting to see whether the Fed can truly engineer, if not a soft landing, then at least not a crash, right?
Correct.
Okay. All right, Lynn Franco, thanks very much. We're going to take a short break, and when we come back, we'll be joined by Erik Lundh, the senior economist, and we'll talk about our forecast for the U.S. economy.
As you and your company monitor the volatile and uncertain economy, the award-winning forecast team at the Conference Board predicts a downturn by the end of 2022. Recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, and as the Conference Board has always done, we are providing you with daily, timely, and relevant content that will guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges. To find out how you can chart a course for the future which will allow your business to emerge stronger on the other side, visit our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host, Steve Odland, the CEO of the Conference Board, and I'm joined by Erik Lundh, the senior economist for the U.S. here at the Conference Board. Erik, welcome.
Thanks for having me, Steve.
So, Erik, we talked to Lynn about in the first part of the program about the consumer confidence results and what CEOs are saying, and the holiday. What do you make of all of that? And what are you taking in and forecasting will happen as a result?
Well, so we're approaching the end of the year. We are seeing growth in the U.S. economy, but we're seeing it moderate. And we expect that it's going to continue to moderate as we transition into 2023, and essentially that we're on the cusp of what's going to be a recession towards the end of this year and into the beginning of next.
Are we in a recession?
It doesn't look like we are quite yet. Some of the numbers that we've been tracking, whether it's retail sales or things like some of the ISM purchasing managers indices, they still show some growth, but we've been watching the trend, and that trend is weakening.
Yeah, but when you look at the growth in those numbers, isn't it just driven by inflation?
Yes and no. I mean, if you look at the top line retail sales numbers recently, they came off as being incredibly strong. But when you pull inflation out of that and look at the real volumes, they did still show a little bit of growth. So we haven't quite dipped our toe into the recession sort of territory quite yet, I don't think. But I do think we're not too far away from it.
Well, as we were talking to Lynn about the jobs market, usually you see jobs start to fall off and layoffs start to happen, and that's kind of the trigger when everybody goes, yeah, here we are, we're in it. This time might be different, right?
Absolutely. I mean, one of the terms that we've been sort of tossing around in ESF has been sort of this concept of the jobful recession. We do expect to see unemployment rise next year, but we don't expect any kind of severe deterioration in the labor market.
Well, I know that there are the official arbiters of a recession, and we're part of the group that makes those determinations. But if you're just trying to run your business and keep your head down, how what do you look at? I mean, how do you know, other than with mass layoffs, which we've seen in some past recessions, how do you know when we're in it?
Well, I mean, it's really going to depend on what industry you're in. I mean, early in 2022, we did see a couple of quarters of negative GDP growth, but it was isolated to certain sectors of the economy. So, as a business owner that's trying to get a broad view of the economic landscape, looking at things like the U.S. Leading economic indices that we produce at the Conference Board, looking at yield curve inversions right now, which we're actually seeing a pretty severe yield curve inversion. Those are some signs that you can point to, the U.S. economy being on the cusp of a recession.
Yeah, although, the total numbers don't show it, but you're starting to hear about layoffs. You heard about it with, Twitter, which you could say, well, that's an acquisition. You hear about it with Amazon, you hear about it with Google, you hear about it with Facebook. So most of the tech firms, have started. You don't hear about retail cutbacks typically until after the holidays, but I don't know. It's just starting to feel like we're sliding there.
Yeah, as I said, I think we're close. The layoffs we've been seeing in tech, I think, are fairly contained thus far, just to that part of the economy. But there's certainly room for that's spreading. And as Lynn noted earlier in the program, the first thing that I think we need to watch are looking at job openings. As those start to be eliminated, that I think is going to be a bit of a bellwether for potential layoffs that could follow it.
Yeah. Now, inflation here continues to rage. We all know that the Fed is valiantly trying to use the dual weapons that they have, both in terms of quantitative tightening, using, moving the assets off the balance sheet into the market, and also the discount rate. They moved now, 400 basis points or so. What do you see? Do you see any impact on inflation so far? Is it working?
I think we have started to see a little bit of an impact. The most recent CPI print came out a few weeks ago, and we did see a little bit of a moderation, not just in terms of the month-over-month rates, but the year-over-year ones as well. That having been said, we're still in sort of exceptionally high inflation territory. So, the hikes that have happened over the course of 2022 will gradually have more and more of an impact over time. There's a lagged impact. And so it's our expectation that we'll continue to see inflation gradually cool into 2023. But I think we're still going to be in a situation this time next year where we're well above what the Fed is targeting, which is a 2% inflation rate.
Why is there such a lag? So the interest rates go up. I mean, my credit card interest rates go up. It looks like mortgage rates have gone. I mean, so why does it take so long to ripple through the economy?
Sure. I mean, it's because spending is staggered, right? Not everyone is going to go turn around and buy a new car or a new house as soon as the Fed increases the rates. So, but gradually these kinds of spending activity occur, or the intentions for it occur. Consumers are going to be more and more responsive to the elevation in the interest rates that have occurred.
Yeah. And, there's also the delay in the rental market. So, a big component of inflation has been housing, and it takes a while because leases renew on average, once a year. And that's, so it takes a while for those leases to go up. And, that's part of it too, right?
Absolutely. I mean, we've already seen a couple months where we've seen housing prices decline. Rental prices have not followed suit and probably won't for a little while, and neither have the owner equivalent rents that the Fed tracks to get a sense of how inflation is impacting the housing market.
Well, the rental market is typically influenced by the housing market, and if people can't afford houses because mortgage rates are too high, then of course, they're pushed into the rental market, and there's more demand for, fewer spots. So, that makes some degree of sense. So, but that suggests that it could take, years here for the whole housing and rental market to even out.
Yeah, and you noted it earlier on. Rents renew, once a year typically. So It takes a while for the calculations for rents contribution to overall inflation to fully work themselves through into the top line inflation numbers.
Now, again, past recessions, every recession is different, but past recessions have resulted in huge job losses. That hasn't yet happened, but I think that, the last data I saw suggested there's still 10 million or so job openings in the market. That doesn't sound like a problem, but then you still hear these layoffs. So talk about the dynamics of all of this, because it's really different than in the past.
Yeah, I mean, so over the course of the pandemic, we saw a massive decrease in the labor force participation rate. So sort of the pool of qualified workers available to take new jobs came down quite a bit. A lot of that was associated with older workers, baby boomers retiring. And then suddenly we had the economy reboot and come back online, a surge for new workers that really wasn't able to find a connection with the supply. And so as a function of that, companies have had a very hard time recruiting. And I think as the economy slows, as we enter a recession, they're going to be quite reluctant to lay these people off, only to find themselves in a situation potentially 6 months down the road where they have to fill this position once again.
Yeah, and it varies by skill set, right? I mean, there are certain skill sets that are still in big shortage, there are others in surplus. Where do you see the skill set shortages? Name a few of the job classifications, and where do you see surpluses?
Well, it's interesting, the areas where we're seeing the need for workers most acutely isn't all that different from where we saw this really before the pandemic. A lot of skilled blue collar workers, for instance, are hard to find. There's also been a transition away from in-person services, so there's shortages there as well. So really, non-college educated workers, manual service workers, skilled tradesmen, things like that are all areas where it's really been tough to recruit.
And we've written at the conference board about the generational effect on this. You mentioned baby boomers retiring. Well, a lot of these skilled blue collar positions, trades in particular, are being vacated by people who are retiring and not being replaced by the younger generations. More of them are going to college. So they're not going into the same professions. And so there is a generational shift here.
No, absolutely. I agree with you on that, Steve.
Yeah. And then there's, not to mention the whole student loan thing and, all the knock-on effects of it. So net, what are we predicting? And you do the forecasts for all of the U.S. economic data here at the conference board. What are we predicting for 22 in total, and then also 23?
So we're thinking we're probably going to wind the year up at about 1.8% for the U.S. economy, but next year we're looking at about 0. That's a pretty flat, ugly number to have to say. But we think we're going to be entering 2023 in a contraction, and so the rebound that we're forecasting to happen towards the end of the year isn't going to be enough to lift overall GDP for the full year. So 0 is the number right now that we're penciling in for next year.
0% GDP growth for 2023. And then how about inflation? What are the numbers that you're projecting for 22 and 23?
Yeah, the inflation numbers, as I mentioned, are going to see a little bit of progress. I think we're going to probably end the year up at around maybe 2.3, 2.4% or so. But it's still above what the Fed is targeting of 2%. And we're not really expecting it to drop all that much more rapidly in 2024. It's going to be sticky. So we'll fall short of that Fed target for 2023, and we'll be grappling with this story probably in 2024 as well.
So the 2022 inflation number for the total year is high 5s, 5.8% or so.
Yeah, that's about right.
About right there. And so you're saying it's still going to be close to 2%, maybe even a little higher for 2023. So this puts us, the Fed has been very public about this 2% target on inflation. They want sub 2% inflation, and they want greater than 2% GDP growth. It sounds like what you're describing is not that in fact it's going to be some sustained and ongoing inflation, and then sub 2%, maybe even flat next year, but then sub 2%. So that's typically referred to as stagflation, right?
It sure does feel like that, and the position that we've even been in this year feels stagflationary. We have had anemic growth for a lot of the year. Inflation has been raging, and so following the recession, I think that we're not going to be kind of past this sort of stagflationary environment on the opposite side of the recession.
Yeah, and the last time we went through this in the U.S., it was the late 70s and early 80s. It was not a fun time.
It hasn't been a fun time this year, and I don't think we're going to, resolve all of this in a year from now when you and I sit down again.
Yeah, so basically, business leaders should be planning on, this this slow situation, very low growth, a little bit higher than normal inflation, and high cost of borrowing. So, that's not great, but that is what we're forecasting, and so therefore, business plans need to be made around that.
Yeah, that's correct.
Yeah. Erik, anything else in the forecast that you'd like to share?
Just that, the story with the labor market is going to be, I think, one of the more interesting, academically at least, corners of this story next year in terms of the overall slowdown, but really not an upending of the labor market.
An upending meaning it's not going to crash like it has in past recessions.
We don't think so.
Yeah, very interesting, and it'll depend on the rate at which baby boomers leave the market, or if they're on a fixed income and they're running out of cash, whether they have to come back in, and what happens to supply and the labor. Man, you got a lot of numbers to track.
It's never been a more interesting job, Steve.
Yeah, exactly. Erik Lundh, thanks for joining me today.
My pleasure.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by prominent thought leaders to provide insights on the issues of our time. We'll cover leading topics in geopolitics, economics, public policy, ESG, and more. Please share CEO Perspectives with your colleagues, with your friends, with your neighbors. Everybody should listen. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.